Experts are saying nothing is safe from what's coming ahead. Everything is exposed, and if you don't act right now, it'll be all too late. The global economy, as you know, is always changing. And recently, we've seen tariffs become a bigger factor. These tariffs can significantly influence your investments. So it's crucial to understand how they work. We're going to focus on a popular ETF, SCHD. SCHD, or the Schwab US Dividend Equity ETF, is a favorite for many dividend investors. It seems like a solid choice, right? But here's the thing, and this might be controversial. Is any investment truly safe from the reach of tariffs? That's what we'll explore. We'll analyze SCHD's holdings. We'll look at which sectors are most exposed. And we'll provide you with the facts. No fluff, just what you need to know to make informed decisions. By the end of this video, you'll have a much clearer picture of SCHD's exposure. Chapter 1. Understanding SCHD. So, let's get into the details of SCHD. What exactly is this ETF? Well, SCHD is designed to track an index. It follows the Dow Jones US Dividend 100 Index. Think of this index as a list. It's a list of 100 of the biggest dividend-paying companies in the US. These aren't just any companies. They have to meet certain rules. For example, they need a market value of at least $1 billion. Also, they must have paid out a certain portion of their earnings as dividends. SCHD's main goal is pretty simple. It wants to give investors a mix of high-quality, dividend-paying stocks. The ETF aims to provide solid returns. It also tries to keep risk low. It does this by sticking very closely to that index. This approach makes it a pretty straightforward investment. The index uses a specific process. It looks at a company's financial strength. It compares companies to their peers. Factors like dividend yield and growth potential are important. The index also considers overall market performance. This gives you a portfolio of about 100 different stocks. Chapter 2. Tariffs and their impact. Now, let's talk about tariffs. What are they exactly? Simply put, tariffs are taxes. They're taxes on goods that are imported into a country. When a country imposes a tariff, it makes those imported goods more expensive. This can affect both businesses and consumers. We've seen a resurgence of tariffs recently. For example, President Trump, during his term, announced tariffs on goods from Mexico and Canada. There were also tariffs on Chinese goods and on aluminum and steel imports. These actions are changing the landscape of global trade. Tariffs have a ripple effect. They don't just affect the price of one product. They can impact the entire global economy. We see this in increased market volatility. We also see it in concerns about slower economic growth. These effects create uncertainty for everyone, including investors. It's like a chain reaction, where the initial tariff can lead to a whole host of economic consequences. Certain sectors are more sensitive to tariffs. Think about industries like industrials and materials. These sectors rely heavily on the flow of goods across borders. Technology is another sector that can be significantly impacted. These sectors often have complex global supply chains, so tariffs can disrupt their operations significantly. Tariffs can lead to higher costs for businesses in these sectors. They can also disrupt supply chains, and in some cases, they can even change consumer demand. For example, if tariffs increase the price of imported steel, companies that use steel in their production may have to raise their own prices. This, in turn, could reduce demand for their products. So, it's important to understand these sector-specific impacts. Chapter 3. SCHD's Sector Allocation. Now, let's look at where SCHD invests its money. This is key to understanding its tariff exposure. We need to analyze SCHD's sector allocation. SCHD spreads its investments across various sectors. As of April 2025, the biggest allocations are in sectors like consumer staples. This sector makes up a significant portion, around 20%. You'll also find a good chunk of SCHD's holdings in sectors like energy, industrials, and healthcare. Consumer discretionary is another sector with notable representation. It's important to understand what these sectors mean. Consumer staples includes companies that make everyday goods, like food and household products. Energy companies are involved in oil and gas production. Industrials produce machinery, equipment, and other manufactured goods. Healthcare provides medical services and pharmaceuticals. Consumer discretionary includes companies that sell non-essential goods and services. So, why does this matter? Well, some of these sectors are more sensitive to tariffs than others. For example, industrials often rely on global supply chains. This means they import and export a lot of materials and components. Tariffs can increase their costs and disrupt their operations. Similarly, the energy sector can be affected by tariffs on oil and gas. Consumer discretionary can also be impacted, as tariffs can affect consumer spending. We need to identify the overlap. Which of SCHD's sectors are also the sectors most affected by tariffs? By doing this, we can get a clearer picture. We can see how much of SCHD's portfolio is at potential risk. We'll also look at some of SCHD's key holdings within those sectors. This will help us understand the potential impact on specific companies. Chapter 4. Analysis of potential risks and opportunities for SCHD. Now, let's get to the heart of the matter. What are the potential risks and opportunities for SCHD investors in this tariff environment? First, let's talk about risks. Tariffs can definitely create some headwinds. One major concern is how tariffs could affect the probability of the companies that SCHD holds. If tariffs increase costs for these companies, their earnings could decline. This, in turn, could put pressure on their ability to maintain or grow their dividends. And of course, dividends are a key reason why people invest in SCHD. We also need to consider different scenarios. What happens to SCHD if tariffs escalate further? What if there's a de-escalation and trade tensions ease? Each scenario could have a very different impact on SCHD's performance. For example, an escalation could lead to more significant market declines. It could also lead to industry-specific drawdowns, particularly in those tariff-affected sectors we discussed earlier. Another risk is the possibility of retaliatory tariffs. When one country imposes tariffs, other countries often respond with their own tariffs. This can create a vicious cycle. It can also hurt US companies that sell goods and services overseas. Remember, many large US companies earn a significant portion of their revenue from international markets. But it's not all doom and gloom. There are also potential opportunities. Some SCHD holdings might actually benefit from tariffs. For instance, companies that focus primarily on the domestic market could see increased demand if tariffs make important goods more expensive. Moreover, SCHD's focus on strong dividend-paying companies could provide some resilience. These companies tend to be more established. They often have stronger balance sheets. This can help them weather economic storms, including those caused by trade disputes. Also, it's worth noting that in periods characterized by slower growth due to tariffs, value and dividend-paying stocks like those in SCHD might outperform growth-oriented stocks. To get a clearer picture, we can look at how SCHD has performed during past periods of trade tensions. While past performance is not a guarantee of future results, it can provide some valuable insights. Ultimately, investors need to weigh these risks and opportunities carefully. They need to align their investment decisions with their own risk tolerance and financial goals. Chapter 5. Conclusion. So, What should investors do with this information? Here are some key recommendations. First, do your own research. This video provides a good review, but it's crucial to conduct thorough due diligence. Look at SCHD's individual holdings. Understand their specific exposure to tariffs. Consider both direct and indirect impacts. Second, stay informed. Trade policies can change quickly. Keep up with the latest developments. Pay attention to any retaliatory measures. This will help you make timely adjustments. Third, diversify your investments. Don't put all your eggs in one basket. Diversification can help mitigate risk. Consider other ETFs and asset classes. This can protect you from concentrated sector exposure. Finally, take a long-term perspective. Tariffs are just one factor. Many things influence market performance. Don't make rash decisions based on short-term fluctuations. Focus on your long-term investment goals. In conclusion, SCHD does have exposure to tariff-affected sectors. These include industrials, energy, and consumer discretionary. Tariffs can pose risks. They can impact company profits and dividends, but there are also potential opportunities. Some holdings may benefit, and SCHD's quality focus offers some resilience. It's crucial for investors to stay informed. Trade policies are dynamic. Conduct your own due diligence, diversify your portfolio, and maintain a long-term perspective. The trade landscape is always evolving. This will continue to affect dividend investing. Understanding these impacts is key. It allows for informed decisions. Thank you for watching. Make sure to click the like and subscribe button before you click off, and share it with your friends.